Hi everyone. So today we'll be covering off the topic of securitization. So today we'll understand the meaning of securitization and how this process works. So first of all, coming on to the meaning of securitization. To understand the securitization process, we firstly need to understand the procedure of banks. How does the bank works? How does the bank carry on their operation? So what does bank actually does? People deposit their money into the banks. So bank takes the deposits of public and then convert those borrowings by lending the sum of money to those who want it. So what does a bank do basically? Bank channelize the funds from those who are having surplus of it to those who wants the funds. So what does a bank do? Bank takes the deposit from public and then lend loans to the public. So bank takes the deposits and lend the loans. So if I draw up income and expenditure statement, or if I draw up a balance sheet of the bank, balance sheet of the bank will consist of assets and liabilities. The liabilities of the bank mainly will consist of these loans. And these deposits form a part of the assets, will come under the assets of the bank. So what does a bank has to do is, out of the deposits, out of the assets, bank has to maintain certain reserve requirements, and the remaining amount can be lent as a loan to the public. So after maintaining some reserve requirements, the bank can further lend the money to the public. So under this channel, in this channel, what happens is that bank has to channelize its assets into the borrowings. If the bank does not have sufficient assets, and once the money is lent to the public, in that case, once the bank has lent the money for like 5 to 10 years, after that the bank cannot further lend further loans unless and until it has more assets so that it can give loans to the public. It means that bank will need a liquidity to survive through the other channel, to go through the other channel of borrowing and lending. So bank would need to fulfill its liquidity requirements, and then only it can lend the money further. Now, how does the bank ensures liquidity? So for that, what do we need to do? We need to opt for a securitization process. If I list down the meaning of securitization, I would say that securitization is a process of converting illiquid assets into liquid assets. So it's a process where the illiquid assets of the bank are converted into liquid assets. So here the bank is under the dilemma that it cannot lend further loans to the public because of the lack of the asset requirements. So what happens under securitization? Bank will satisfy its liquidity needs and it can further lend the money to the public and continue the cycle of lending and borrowing through the securitization process. So this happens under securitization, that bank illiquid assets will be converted into liquid assets. But how this procedure takes place? Let's see. So what happens under securitization process? Under securitization process, the assets of the bank, the assets which are held by the bank, is transferred to an investment bank. So bank transfers all its liabilities to an investment bank. So the liability held by the banks will be transferred to the investment bank. So under this, what happens? Whatever will be the liabilities, that will be transferred to the bank. So the loans will be transferred to this investment bank. And then this investment bank will divide this loan amount into an investment package. The investment bank will take all the loans from the bank and convert those loans into an investment package that is known as CDOs. CDOs basically means collateral debt obligations. So what happens under the securitization is that this bank will transfer all its loans to an investment bank. Hence, the liability side of the bank statement will be removed. And that investment bank will convert these loans into investment packages that will be known as CDOs, collateral debt obligations. So investment bank converts the loans amount into CDOs, into some investment packages. Now what happens? These CDOs are being availed, or these CDOs will be further availed or issued to the public. Now these CDOs will further be issued to the general public. Now this public will assess its return and the risk requirement. They'll estimate their return and risk levels, and accordingly they'll decide what CDO, what type of security they want to invest in. So if I repeat the process, I would say that the bank loans will be converted into CDOs by an investment bank. Now those CDOs are basically the package, the investment packages that will be invested by the public. The money will be invested by the public into these CDOs. So public will provide the money to the investment bank today by making investment in these CDOs. That money can further be given to the bank so that bank can continue its channel of further lending and borrowing. Now bank has met its all liquidity requirements. Bank will be further able to lend the loans and continue the channel of borrowing and lending. Now what happens to this investment bank? Investment bank has divided this loans into CDOs. They has divided all the loan amount into different packages, I would say. So investment bank will convert the loan amount into different packages or different investment. Investor will assess their risk and return level, and accordingly they'll put the money into this investment, and that money which is put by the investor today can be used by the bank to expand its liquidity position. Now, the investor who has provided the money to the bank, they've been issued the securities by this investment bank. Now, this investment bank has converted this CDOs or the loans which were very high rated, like the AAA loans. They were converted into very less risky security. That particular AAA loans were converted into an investment package or security which is very risky, very less risky. Then the poor rated loans which the bank has lent to the public will be converted into the security which are very high risky. So now the investor will access the risk and returns level, and accordingly the investor will decide whether he wants to invest or not. So what happens that the loans which were given by the bank could be of different credit ratings, AAA or B rating, AAA, AA, B ratings. So what an investment bank will do is they divide the complete loan amount into different tranches. Tranches is basically a category. Tranche is basically a category. So the complete loan amount is divided into different tranches. So loan is divided into different categories according to the risk and the return level. Now those investors would have to see and assess what are their risk and return position, and accordingly they will decide whether they want to undertake the investment or not. Now the loan amount can be divided into different tranches. So tranche 1 will be the high risky security, tranche 2 is the intermediate risk security, and tranche 3 will be the senior tranche, the very high security security investment. Now what will happen is those to whom the bank has lent the money, those who are the borrowers, borrowers will pay the interest to the bank. Now as soon as the bank receives the income from the borrower, for the bank it is an income, bank will first make a payment to AAA rating bonds, or bank will first make a payment to tranche 3 holders, investment holders. Now after that, if any other income is received, that will further be transferred to tranche 2 investment holders. If any surplus is left, or if the very risky borrowers, very poor rating borrowers, if they provide the return to the bank, then the equity tranche will be paid off. So according to risk and returns, those which are very less riskier investments made by the bank, or very less risky borrowers, their income, their interest income will firstly be used to pay off the tranche 3 level investors, and thereafter tranche 2 level investors will be paid, and afterwards tranche 1 level of investors will be paid off. So this is how the securitization procedure works. So let's read the theory of this securitization. So under securitization, what happens? The bank will be able to convert its illiquid assets into liquid assets. How does the bank do that? Bank will transfer all its liability to an investment bank. In return, bank will receive a money today. So that is how the illiquid assets will be converted into liquid assets. Now, so how does the bank perform? Here is the procedure given. So bank will convert all its mortgages, credit cards, car loans, and all other form of credit the bank has lent to the public. They'll convert such loan into the investments. So bank will transfer all the bank will basically remove all the liabilities from its financial statements and give it to the investment bank. Investment bank is also known as SPV, special purpose vehicle. So bank will provide all loans to the investment bank, and in return investment bank will provide all the money which it has received from the investments to the bank. So now the bank is back to its own liquidity position, and it can further lend the loan to the public. Now, this statement says that securitization can also be used by the companies which receives rental income from the commercial property. So any sort of income is pending from the public, that can further be converted into the CDOs packages, and CDOs packages can be further converted into different tranches, and now the investor will put their money into the CDOs, into the tranches, and that money can be further provided to expand the liquidity position. And then whenever the rent is received from the property from the property holder, that could be paid, that rent can be used to pay off the investors. Now let's see an example.